An insurance binder is temporary proof of insurance. In real life, it shows that coverage has been arranged before the full policy documents are issued. The pressure comes from this. Binders are common in home, auto, and business insurance. The result can be they help transactions move while paperwork is finalized. A binder is not just a casual promise. Think of it as usually a written document showing key coverage details. The process works because the insurer or authorized agent is temporarily binding coverage. Over time, the exact terms and dates matter. Real estate closings often need binders. A simple case is this. A lender may require proof that a home is insured before funding the loan. The important driver is that the binder lets the closing proceed. That is why without it, the purchase can be delayed. Binders are temporary. You might see it when they may last days or weeks until the formal policy is issued. What matters underneath is that the expiration date should be checked carefully. If it is ignored, assuming temporary proof lasts forever can create a gap. The binder should identify the insured. One ordinary version is name, property, vehicle, or business must be accurate. The mechanism is that mistakes can create coverage confusion. The practical effect is reviewing basic details immediately prevents bigger problems later. Coverage limits should be visible. Consider the binder may list liability limits, property limits, deductibles, and covered items. The hidden part is that these figures should match what was requested. The outcome is often that a wrong limit can affect a claim even during the binder period. Effective dates are critical. The pattern shows up when coverage may start at a specific date and time. The moving force is that a loss before the effective time may not be covered. The risk is that timing matters when a purchase, loan, or move is happening quickly. A binder can be conditional. In a daily situation, coverage may depend on payment, underwriting review, inspections, or missing information. The link is that temporary proof does not always mean final approval is guaranteed. Once that link matters, buyers should complete requirements quickly. The final policy can differ if underwriting finds issues. The clearest example is a property problem, driving history, or business risk may change terms. The explanation starts with the insurer may adjust, cancel, or refuse final coverage under allowed rules. The consequence is the binder period should not be treated casually. Payment status matters. For example, some binders require a premium deposit or full initial payment. The reason is that unpaid coverage may not remain valid. That can mean receipts and confirmation should be saved. A binder is different from a certificate of insurance. In real life, a certificate summarizes existing coverage for a third party, while a binder can temporarily create coverage. The pressure comes from this. Mixing them up causes confusion. The result can be the purpose of the document matters. Agents must have authority to bind. Think of not every broker can place coverage instantly with every insurer. The process works because authority depends on agreements and underwriting rules. Over time, customers should ask whether coverage is truly bound or only quoted. Binders can help businesses start contracts. A simple case is this. A contractor may need proof of liability coverage before beginning work. The important driver is that temporary proof lets the project begin on schedule. That is why the full policy should still be reviewed when issued. The binder should match the requested risk. You might see it when wrong address, wrong vehicle identification, missing lender, or incorrect business description can cause problems. What matters underneath is that speed should not replace accuracy. If it is ignored, small errors are easier to fix early. Cancellation rules still apply. One ordinary version is temporary coverage may be cancelled if requirements are not met or risk is unacceptable. The mechanism is that notice rules vary by policy and jurisdiction. The practical effect is customers should watch communication during underwriting. A claim during the binder period is possible. Consider if a covered loss happens while the binder is valid. the insurer reviews it under the bound terms. The hidden part is that documentation still matters. The outcome is often that temporary proof does not remove normal claim conditions. The full policy should be checked after issuance. The pattern shows up when limits, exclusions, endorsements, names, and dates should be compared with the binder. The moving force is that final documents are the long-term contract. The risk is that mistakes should be corrected quickly. Lenders and landlords may request binders because they need assurance. In a daily situation, they want proof that the asset or activity is protected before money or access is released. The link is that the binder serves that timing need. Once that link matters, it bridges the gap between agreement and formal paperwork. A binder is useful because insurance often must be proven before the final policy is ready. The clearest example is it keeps purchases, loans, moves, and contracts from stalling. The explanation starts with "but it must be read carefully because temporary does not mean vague." The consequence is the topic is understood through a binder is useful because insurance often must be proven before the final policy is ready in practical terms. Insurance binder becomes clearer when it is tested in ordinary life. Take home closing before policy documents arrive. The point is visible in a home closing before policy documents arrive. The choice changes because insurance binders changes the pressure around the decision. What matters is the real consequence for the people involved, not just the clean definition of insurance binders. When the example is concrete, insurance binder stops sounding abstract and starts looking like something people deal with in real conversations, bills, deadlines, and relationships. Another useful angle is temporary proof of coverage. A temporary proof of coverage shows how one background condition can change the outcome before anyone calls it a big event. For insurance binders, the hidden force is temporary proof while the formal policy is still being completed. Once that timing is clear, the binder feels less like a shortcut and more like a bridge. A binder is useful only because timing matters. The buyer needs proof of temporary coverage before the full policy is formally issued. A weak reading treats the binder as the entire policy and misses expiration dates and final terms. In the case of binder expiration date, the final result may look simple from the outside, but the pressure was already building before anyone noticed it. Better judgment starts by confirming what the binder covers, when it begins, and when it ends. A practical example is lender requiring evidence. The practical point is not to memorize a slogan about insurance binders. The practical point is to use the binder carefully until the full policy documents arrive. That contrast explains why temporary coverage should still be read carefully. Most confusion around insurance binder comes from missing that hidden exchange and focusing only on the surface event. An insurance binder is temporary proof that coverage is in force while the formal policy is being completed. A final example, final policy replacing binder, shows why this matters before the outcome becomes expensive, stressful, or emotionally charged. The strongest takeaway is to confirm the binder's dates, limits, and replacement policy. The practical point is to use the binder carefully until the full policy documents arrive. Once those parts are visible, insurance binder becomes less mysterious and much easier to handle in daily life.